Good morning and welcome to this Wednesday, April 5th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, let's see. Currently, we have futures down slightly. Dow Jones futures, and this was as of about 10 minutes ago. Dow futures down 46, S&P 500 futures down about 9. NASDAQ futures down 16. Crude oil down about 27 cents, back to about 80.5 a barrel. And the U.S. 10-year Treasury yield down 4.5 basis points this morning, 3.29%. We had the ADP employment report out this morning, which is a precursor to the jobs report on Friday. And I've seen these reports vary. Now, apparently, there's been some work done to the ADP employment report to try and get it a little bit more in line. We'll see. But this report came in, let me see, I think it was 145,000 jobs. Yeah, the actual number was 145,000. The market was expecting 200,000. So it's positive, which is good. And it was less than expected, which I think is also good. So it's telling us that perhaps, and I say perhaps, I'm holding out for the jobs report on Friday, but perhaps it's telling the Fed that, yes, the economy is slowing a little bit. We didn't create the jobs that we thought we were going to. As a result, the 10-year Treasury yield is down. Not only is it down, but it is threatening now the lowest. Well, I'm going to go, I'll show you the 10-year Treasury yield in just a couple of minutes. We'll look at that chart. But we're threatening some really important short-term lows with the move down in the 10-year Treasury yield today. And I think that can boost stocks going forward. I think that could be a big lift if rates come down. Remember, rates going up and the anticipation of the rates going up, in my opinion, is what drove the stock market down in the first place. I don't think it was the expectation of long-term inflation. The market really has never given that signal, bond market anyway. And so I think it's more about, I think it's much more about the short-term, the short-term anticipation, I guess, if you will, of rates being higher. Because if rates go up, valuations automatically go down. As a former practicing CPA, I can tell you I did valuations. If your expectations change on future interest rates, well, using the current rate, if the current rate's going up, that is going to lower the value of the future earnings. Any future earnings you have, if you're discounting those future earnings back using a higher rate, you are going to come up with a lower valuation. It's pure math. So now we're looking at the opposite. You wonder why is the stock market going up? We got all this bad news. Part of it is because the 10-year Treasury yield has dropped from 4.3% to 3.3%. Again, those interest rates, long-term interest rates, when they drop, that's a boon to valuations of public companies because their future earnings become more valuable. And companies that are expected to grow those earnings even faster than others will see more of an increase. That's why as rates come down, I favor growth stocks. They don't always outperform, but generally, if rates come down, companies that grow their earnings the fastest will normally see their valuations go up the fastest. So need to keep that in mind, and especially if rates continue to go down. When you look back at 2020, I'll go ahead and share my screen here just so you have something to look at. And we'll get into yesterday's action in just a minute. But if you look back to 2020 in the pandemic and think about what led the market to the upside, what really took off, it was many high growth technology companies. Why? Well, look at what interest rates did. With the pandemic, interest rates absolutely fell through the floor, literally almost through zero. We got down close to zero on the long-term interest rates. Valuations, when you start looking at those future earnings, valuations go through the roof. And so it shouldn't have been a shock that 2020 turned out to be such a strong year. Anyhow, that could be a different show all in itself. Let's take a look at what happened yesterday. The Dow Jones Industrial Average finished down almost 200 points, 0.6%. S&P 500 down 24, which was down almost 0.6% as well. NASDAQ down 63, did a little bit better, down about 0.5%. Mid caps down 43, though. That was down 1.7%. Small caps down 23. That was almost 2% down. Small caps, mid caps continue to underperform. And you can see the money rotating. If you look just at the AD lines, look at the bigger, larger indexes, the Dow, S&P, and NASDAQ. All the AD lines moving up. Look at the mid cap and small cap. Not only are prices going down, but we've seen the accumulation distribution turn lower as well. Money, I think, pretty clearly is rotating away from small and mid cap stocks. And you might say, well, why? Does it matter? Will it feel better if you're holding small and mid cap stocks and you're losing money if you know why? One thing I learned a long time ago in technical analysis, why questions don't matter. If you're following the price action, who cares why? It's going down. You don't want to be there. It's an underperforming area of the market. You want to be where the money is going. So if you're following the charts, look for relative strength. Avoid relative weakness. If you can do those two things, you'll be really a great investor. You will be one of the best investors of all time. Now, it's a lot easier said than done, because sometimes you see strength and you're like, oh, this area is really strong. I'm going to jump in. And of course, as Murphy's Law would have it, you're nailing pretty much the top at that point, and then it starts to underperform. Then you get, so it's not easy. But I think if you look at the big picture, I think you can get a pretty good sense. And we're going to talk a lot about the big picture in just a little bit. Looking at the sectors from yesterday, utilities up 0.5%. That was your leader, which isn't too unusual. When the market's down, we do tend to see money rotate a little bit more toward defensive areas. So anytime the market's lower, I'm not shocked if we see utilities or consumer staples, healthcare, real estate. Those are the areas that tend to do better when the market is moving down. Communication services, though, also up 0.3%. So that was nice. But here were your laggards. Industrials down 2.25%. Energy down 1.8%. Remember that huge up day that we had in energy on Monday? Yeah, that disintegrated yesterday. We lost a lot of that gap. Trading back down close to the 50-day moving average. Held on to it. So I'd like to see that hold. But honestly, I'm probably looking more at gap support. I mean, as we're coming down, this now looks like maybe a move down to put in the left shoulder, move back up. Maybe that's left side of a neck, come back down. That could be the head. You move back up, right side of the neckline, which is slightly higher. I like that upsloping neckline. Right shoulder pullback could be all the way back down near the 20-day and near this gap support. So if we do pull back on energy, I would be watching most closely maybe around $82 to 82.5, 83, somewhere in there. That would be the support area that I'd really want to make sure holds on energy. I mean, after getting the good news on the production cut, the OPEC production cut over the weekend, saw that big move up. The last thing we want to do is on the heels of that, turn around and go right back down into that downtrend. So I would say right around $82 would be kind of a line in the sand for me on the XLE. Short term, I'm talking about. Materials, also rough day, down 1.4, almost 1.5%, rolling back down below the 50-day moving average. We have seen a little bit movement. If you look back over the last 3 or 4 months, we put in a lower low. If you just look back the last couple of months, right now, it looks like we have a couple of lower highs. We got a lower low. It seems like we're starting to roll over in materials. And off of the longer term picture, you can kind of see this could be a left shoulder, neckline. There's your head, come back down, a down sloping neckline, which is not good, especially if you break it. Then you come back up, you put it in a down sloping right shoulder. So if we were to move back down below 74.75 on materials, that would be a sign to me to stay away from materials. I mean, I'm not a fan of materials right now anyway. I think they tend to do good in an inflationary environment. I think as the market begins to worry less and less about inflation, I think materials could go up. I just think that they're going to be an underperformer. I think the market goes up. I just don't think materials keeps pace, just based on what I'm seeing now, and that's my opinion. We'll see what happens. 10-year Treasury yield. So here's what I was talking about. Let's get an update, see where we are right now. We're sitting right at 330. The low was 3.292. And you can see going back since we peaked back in October of last year in this 10-year Treasury yield. By the way, when did we bottom in the S&P 500 and NASDAQ? It was October, right when the yields peaked. Correct? So as we've been going down, we have seen the market rising. Again, that gets back just to basic valuation principles. As that yield comes down, I mean, if you think about where we were back in the 1980s and where we are now in the market, a lot of that stems from the fact that interest rates fell from ridiculous levels, way up into the teens, all the way back down to near zero in 2020. So a lot of that movement up over the last 40 years was fueled by consistently lower Treasury yields. You still go through periods where the market's overpriced. And so you can still go through a secular bear market, which is what we did in 2000 to 2012, 2013. That whole time period, interest rates kept going down. Valuations didn't go up, though. Part of it was because we ran so much at the end of the 1990s that we simply saw money rotating out of U.S. equities, out of that asset class and into other areas. We saw commodities take off. Inflation picked up. Number of things happened, but money was not going into U.S. equities. Again, it's the big picture look. You know, you can just because rates come down doesn't mean you can't go parabolic to the upside and simply get too far. And that's what happened in 1999 and 2000. Anyhow, I think the rates coming back down, that's why I continue to watch these recent support levels, because if that breaks to the downside and you're looking for a catalyst to take the market up, this would be a big one. I mean, if I'm in the bearish camp, I do not want to see rates going down. You might say, well, yeah, but if we have a recession, that means, you know, we're going to have GDP dropping and the Fed will lower rates, and recessions will be great for, you know, to generate a bear market. Well, I would suggest maybe you take a look at history, because that's not always the case. If you look back at even 1990, when we had the Persian Gulf War, we had a recession. We had a cyclical bear market that priced in the recession before it started. And the stock market started taking off in the midst of a recession. So these cyclical bear markets a lot of times price in what we later see fundamentally. If that interest rate right there breaks down, I think it is going to be a catalyst for another big move up in stocks. Now, one problem is that it's given us a lot of head fakes since December. Even though I think the overall trend looks to me like it is down, we had this low, looked like, okay, here we go to the upside. Then we're like, oh, broke down below that prior low. Here we go. And then what happened? We stabilized. Rates started going back up. And when rates went up, what happened to the stock market in February? Well, right here, when we made this breakout mid-February and March, weren't very good. But then what happened in the second part of March, or last few weeks of March? NASDAQ took off. Why? Interest rates. So you got to watch this, keep this in mind. And we got a big non-farm payrolls coming up on Friday. All right, just a quick look at the S&P 500. So here was that move I was just talking about the last 3 weeks or so, moving up while the yields were moving down right here. So does the S&P 500 break above 4,200? Well, part of that might be answered by what happens in the bond market. So keep an eye on that 10-year Treasury yield. I think we're going up. I think it's going to be a much more difficult path to the upside if rates don't go lower. If rates stay where they are or start to trek back up, I think we're probably going to see more sideways action. Maybe we make the breakout, but I don't think it's going to be as robust. Ultimately, and I've been saying this for a while, the S&P needs to clear the August high. That's the one that you've got to clear. And when you're looking at the NASDAQ 100, we're getting closer. We've already cleared the February high. And you can see NASDAQ outperforming over the course of the last few weeks as rates drop. Why? Because the NASDAQ is home to more aggressive growth stocks. At least they're more heavily weighted. The S&P has some great aggressive growth stocks in it. It's got Apple, Microsoft, NVIDIA, all the same players that we see, or many of the same players we see on the NASDAQ 100, but those names are more heavily weighted on the NASDAQ. So when you get a stock like Apple making a really big move like it is right now, it's taking both indices up because it's the most heavily weighted stock on both the S&P and on the NASDAQ. But it's it's close to twice as heavy a weighting in the NASDAQ than it is in the S&P. So it's lifting both of them, but not proportionately. It's actually lifting the NASDAQ more. And that's why we're getting that outperformance right now. All right. Hold on, grab a little water. I don't know about all of you, but man, the springtime and the allergies take a toll on me. All right, so let's take a look at the, I wanted to pull up a chart on the bank index. I wanted to go back 20 years, and I wanted to show you something you might not be aware of, because right now banks, even though they bounced a little bit last week, they are really, really struggling. Probably one of the worst areas of the market, and I'll show you a couple of charts that can really identify that for you. But here, this is a seasonality chart of the bank index going back the last 20 years. And what I find interesting is if you add up the average returns for each calendar month, January through June, let's do that real quick. Minus 0.7, minus 0.6, minus 1.1. That right there is minus 2.4. Then add 2.2. So now we're down to minus 0.2. Add minus 0.4. That's minus 0.6. And then June. So that's minus 3.1. That's the average return on banks over the first 6 months of the year since year 2004. So this goes back 20 years. And banks, in the first 6 months of the calendar year, have lost an average of 3.1%. You go to July and you start adding these across, 2.6, then it's 2.3, 2.1, 3.6, 5.2, and 5.9. Second half of the year, banks have averaged gaining almost 6%. And when you combine the two, you're looking at roughly 3% annual gain if we just average or add the average monthly returns coming across here. That's not very good, especially considering the last 10 years, we've been in a pretty nice bull market. I mean, we've had some cyclical bear markets along the way. We had the 2018 trade war, fourth quarter, remember? Not very good there, market down over 20%. We had the pandemic. We saw the S&P drop 35%. Then, of course, 2022 with inflation and interest rate fears, blah, 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 lost on the S&P almost 28%. Going back or going through a period of about 5.5, actually turned out to be a little over 9 months all the way through October. So, we've had a few rough periods, but for the most part, if you look back at where we were in 2013 and where we are now, I mean, we've had a really good run, probably averaging 11% on the S&P 500. Banks only 3%. They've been underperforming. And I want to show you a chart on the banks. I want to show you this relative to the S&P 500. You might find this really, maybe even a little bit shocking. Let's change this to a line chart. Don't need the volume. And let's just go back. I don't know, 40 years, that might be too far. Yeah. Let's go back just 25 years. So look at where we were back in the financial crisis. 2008, 2009, during this massive drop. This is where banks stood relative to the S&P 500 at the bottom in 2009. I mean, there was nothing but carnage everywhere in the banking area. And yet, where are we now? We are threatening. It actually looks like maybe we have moved to the lowest level we've seen since the bank index started back in 2000. There are probably some other bank indices that we can use, but the Dow Jones U.S. Banking Index, the DJUSBK, started back in 2000. If you look at it, it's been awful, really, since 2004, 2005. You got into the subprime mortgage issue, and then into the financial collapse, the whole Bear Stearns, Lehman Brothers, what banks are going to survive kind of a thing back in 2009. And believe it or not, the pandemic took us below that 2009 level. And this bank crisis, which seems like, okay, it's an issue. I mean, we had some banks really that were poorly managed, and we were worried about some fallout. Honestly, I'm more worried about the bank crisis than I am inflation or interest rates. This bothers me more than anything else, because the banks are heart and soul of our economy. I don't like to see this. Banks don't have to be the leaders. They're not the high growth companies. They're rather predictable in a solid economy normally in terms of their profits. So they're not going to shoot up because their earnings are growing so rapidly, not like semiconductors or software stocks. So I'm not looking for this relative chart to go screaming higher for us to be in a good, solid bull market. But from 2013 all the way over to the pandemic, I mean, we just kind of went along for the ride. Banks kind of performed with the S&P, and that's fine. When they underperformed, obviously that took a big toll on the stock market back in March of 2020. And when they rebounded, that certainly helped the market when we came back. So the fact that they're dropping, I mean, if I'm putting together my list of bearish thoughts, this is going to be right near the top of what I would be most concerned about. Not inflation. Forget about what the media is talking about. The media is still talking a little bit about the banks. But JP Morgan CEO Jamie Dimon came out and said, this isn't over. And I got to tell you, based on the way the banks are trading right now, I agree with him. Now, the question is, do the banks take the overall market down with it? And you may have different thoughts on that. I mean, if you go back and you look, 2007, 2008, 2009, I mean, I had a friend of mine who was a CFO for a pretty big home builder back in the Maryland area. And they also had a resort that they managed or that they owned and managed as well. And they had a lot of employees. And I remember having a lunch with him probably in September or October of 2008. And he wasn't working for a bank. And he said his business, they might not be able to meet payroll because he didn't know if he could get the funds from his bank. So when things get so bad in banks that they begin to affect other areas of the market, yes, you could see a big, big drop. Could that happen now? Sure, it could. I think banks are much better capitalized. Even Jamie Dimon in his talk said, yeah, banks, we got issues ahead, but this is nothing like 2008, 2009. It's not the financial crisis. So even somebody who tends to be very conservative and tends to issue a lot of warnings is telling us it's not like 2008, 2009. Don't worry about that. I suppose it could morph into it. We don't know. But yeah, that would be one of my biggest concerns in the market right there. The other thing I in our earnings beats digest, I put this chart in this morning. This is a seasonality chart of JP Morgan for the last 20 years. Look at the first 6 months. Look at the odds of any particular month going higher. Most of them, half of them in the 30s and 40s percentile. The highest is 60%. Then you look at the second 6 months of the year. Look at how much more often JP Morgan rises in the second half of the year. Now, when I see something like this, I try to think, okay, why does something like this happen? Why would banks do better in the second half of the year? I'm not really sure. But it seems pretty obvious. I mean, if you add the numbers across the bottom here, we see JP Morgan barely making any headway. This is one of the leading banks, making almost no headway over the last 20 years in the first 6 months of the year. But then you get to the second half and all of a sudden, nirvana. Anyway, I thought that was interesting to point out. If you want to check out our chart of the day over at Earnings Beats and have it mailed to you directly, just go over to our website, earningsbeats.com, scroll down, find this area to sign up for our AB Digest, put in your name and email, hit that subscribe, and you're set up. The other thing I want to mention is in about 30 minutes, actually, let me give an update here because this should refresh. There we go. 32 minutes, 50 seconds, registration opens for one of the biggest events that we're going to have all year. Saturday, April 15th, the Bullseye Forecast. I'm going to give you my thoughts on where the market's going, what it looks like right now. I can tell you seating is limited. So you're going to want to make sure you get registered, number one. The other thing I want to point out is if you are a member of Earnings Beats, your seat is guaranteed. So this would be a good time to start your 30-day free trial because not only, first of all, you don't have to pay anything. So it's a great value there, but it will guarantee you that you're in on this webinar on Saturday, April 15th. We make sure that our members are able to access all of our webinars. And this one is no exception. So definitely think about getting that started. But at a bare minimum, you'll want to check this out. Let me talk a little bit about some of the calls that I've made. But before I get into that, I just want you to see the history of the stock market. I show this chart over and over and over again. Many of you who followed me probably have seen it, know exactly what I'm going to talk about. Some of you, though, if you're new, you have to understand the grand super cycles that the stock market goes through. You go through these long-term secular bear markets where you just make very little or no headway. And then you go through these long-term secular bull markets where we just keep going up, 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 up. 1950s, 1960s, 20 years, up, up, up. 12 years going nowhere. 1980s, 90s, 20 years, up, up, up. 12, 13 years, nowhere. Now we're into our 10th year. The last two have been 20 years. I think this grand super cycle isn't over. Every time we have a pullback, everybody screams, depression. They can't fathom the thought that the stock market naturally just needs to pull back. We had one of the biggest runs in the history of the stock market from March 2020 to January 2022. And if you look at the S&P 500, this is a chart showing you, this is monthly chart of the S&P going all the way back to the 1920s. And this shows you down here on the bottom, the 24-month rate of change. And what I just want to point out here is that when you look back over a 2-year rate of change, you can see if you get up into this 70% range, the S&P 500 since 1950 has gained an average of 9%. So over a 2-year period, the expectation would be 18%, right? 9% twice. That's if you just had average S&P 500 years. That's not how the stock market works. We go through boom and bust periods in the stock market. And you got to be careful when you get a big boom period. And look at when we have gone up 70% or more in 2 years. Down after that. Here we are up here. Down after that. Here, well, 1999 was maybe one exception. We had one final push to the upside. And then big secular bear market there. Here, 87, we had the crash. Here in 76, year and a half down. How about over here in 55, late 55? Cyclical bear market. How about 37? Big move up, down. How about 34? Down. The market can't sustain these moves. Everybody gets bullish. Oh, making money. Let's just pour more money in the stock market. Pour more money in the stock market. Well, guess what? We run out of money to put in the stock market. And you've got to be careful, which is why the last 4 market vision, 2020, 2021, 2022, 2023, I give my forecast for the year. In 2022, one of the reasons I said that the S&P 500 could drop as much as 20 to 25% to 3,500 to 3,800. And yes, you're reading that right. I said that on January 8th, 2022, when the stock market was near its all-time high, before everybody else started getting bearish. One of the reasons was we had just had an unsustainable move to the upside. You have to understand history. I'm not making any of this up. When you have a huge 2-year move, you follow it with problems. It always happens. Well, 1999 was an exception. Okay, so it doesn't always happen. But just think common sense, logically. The stock market, what's the GDP go up every year? 2%, maybe up to 4%, kind of like the norm. Throw on inflation, 2 to 3% average over the years. So what are you up to? Maybe at the top end, 6-7% GDP plus inflation. Then throw in innovation, because sometimes, companies just perform better than others, right? Apple performs better than a lot of companies. They're managed really well. They're innovative. They've got great customer service. Stocks like that bring the S&P up above what you would expect for GDP plus inflation. It's the innovation. It's technology. Those are the things that help drive. And that's why technology tends to lead bull markets. So when you're looking at forecasting the stock market, it's more than just cheerleading and saying, oh, we had such a big advance. We're going to go up another 20%, everybody. That's not the way it works. You're doing no one any favors, especially yourself, if you look at the market like that. This cyclical bear market that I said could last, I thought it would be 3 to 6 months. I thought the June low was it. And I really think if Fed Chief Powell hadn't screwed up at his August speech and started, I think a lot of stock market participants lost confidence in the Fed right there. And I think that's the only reason we ended up going down one more time. But we did. And I actually did shows, wrote articles and said, end of September, I was like, here's your chance, bottom 2.0. We went down a little bit more at the beginning of October. And then boom, the low in October is 34.91. Pretty close to the low that I gave of 3,500 back in January. I'm telling you, we're back in the secular bull market. We're going up. You can think we're going down, and there's a chance we go down. I'm not saying it's a guarantee we're going higher, but I do a lot of research in the stock market. And I know we're past at 9:30. This is pretty important stuff. I've done a lot of research in the stock market. I'm just not making stuff up. If you look at my forecasts in 2020, of course, I didn't know the pandemic when we had Market Vision 2020, but I was kind of playing on numbers. I really thought we were going to have a good year. And so I just picked 40-40 just because it was our first Market Vision event, 2020, 40-40. Kind of see where I'm going. Anyway, then of course the pandemic hit. And during the pandemic, everybody said, this is it, Great Depression 2.0. And I remember writing articles, talking to members right in the middle of that saying, we're going to come right back. This is a healthcare crisis, not a financial crisis. And what did we do? We came right back. And you know what? We got back up to 3,700 from starting the year at 3,100. We almost got up to that 4,000 level. And I think we'd have gotten there had it not been for the pandemic and all the fear that it created. 2021, I said the S&P is going to gain 1,000 points. It gained 1,010. I was off by 10 points. I mean, some of this is luck. Listen, I don't know it's going to go up 1,000 points, but I was bullish. That was the key. Starting this year, I said it was going to go down. I thought the fourth quarter was going to be strong. And it was a little bit on the S&P, not so much on the NASDAQ. I think we've seen more of that here in the first quarter. So I was a little bit delayed on that. But I gave my forecast in 2023, beginning of January, and I said we're going to have a strong January. We were going to pull back maybe to 3,800. We got down to 3,808 or something like that. And then I thought the market was going to take off. And look at what we're doing right now. We're taking off. Where are rates going? Lower. I'm going to update all of this on March 15th, April 15th. I could really give you a forecast on March 15th. April 15th. So coming up in just a couple of weeks, again, if you go back to our website, it starts, no, doesn't update, I guess, until I update. There we go. 23 minutes. We open for registration. I hope you'll check it out. Anyway, let's take a look at the market, see what's going on here. We'll wrap up. I do apologize for running late, but I think this stuff's really important. All right, so we got the Dow up 77, a little bifurcated action to get started. Dow up 77, NASDAQ down 65, S&P kind of right in the middle. You can see the NASDAQ 100 down pretty close to the NASDAQ. So the large cap growth stocks performing about like the NASDAQ. Let's see, AXP down. I was looking for a breakout on AXP. They've not been performing well. I think part of it stems from all this money rotating out of financial stocks. You can see Goldman Sachs. There's JP Morgan. Again, worst performers. And then up healthcare. Really a lot of healthcare at the top. J&J, UNH, Merck. Then you got consumer staples there, Procter & Gamble. You got Amgen. So you definitely got some healthcare leading the Dow, and certainly looks like that's what's carrying everything at this point. Anyway, that's it for me. I certainly appreciate you tuning in. Thank you for watching on our new YouTube live stream. If you like what we do here at Earnings Beats, please click the like button and subscribe. Tell your friends. We're trying to educate the public. Don't listen to the media. Many of the articles that you see, they're clickbait. People don't do research. They give you their opinion. They hear something, and then they write an article about it. They're trying to get viewers. We're trying to educate. One of the reasons I love working with stock charts is because that's what they do. They educate. They're not CNBC, who's more excited about entertaining and increasing viewership. Stock charts is interested in education, which is why I love our relationship with stock charts. Anyhow, everybody have a great day. I'll be back tomorrow over at Stock Charts on Stock Charts TV at 9 a.m. tomorrow. So if you want to catch our next show, Trading Places Live, go over to Stock Charts TV tomorrow morning, 9 a.m. Hit that button and you can join in. Have a great day, everybody. Happy trading.